Welcome to another edition of Think with a Drink. This is the weekly webinar series brought to you by the ARIES Foundation for Financial Education. And this week's topic, we are doing types of life insurance explained. And what we mean by that is there's a whole slew of different types of life insurance out there. And it gets a little confusing sometimes, a little daunting for people. And all we want to do is break it down, try to make it easy to understand and grasp what each of them does, good, bad about them, and maybe who would be most appropriate for those types of insurance. Before we get started, all right, so your pilots, your presenters for tonight, my name is Tom Alessi. I am the president of the ARIES Foundation. I have been in financial services now into my 24th year. I'm an investment advisor. That means that I act as a fiduciary whenever giving guidance or advice to any of my clients. I want to introduce my vice president, Craig. Why don't you introduce yourself?
Sure. So I'm Craig Richardson, vice president of the ARIES Foundation. I've been in financial services a little over 18 years now, and my specialty is working with families to help them define their financial goals and have a better future with their money.
And Craig will be joining us as we go along this evening. Like I said, he's also there in case some questions pop into the chat box. Try to keep this flight on time as we move along here. We did tell you that Think with a Drink is brought to you by the ARIES Foundation for Financial Education. You can visit us at www.ariesfoundation.org. We are a nonprofit whose mission is dedicated to the idea or concept of trying to help everyone have a better relationship with their money. Because whether you realize it or not, you are in a relationship with money. And just like every other personal relationship that you have in your life, there are triggers and emotional behaviors that occur that cause us to act irrationally sometimes when we're dealing with our finances. All myself, Craig, the rest of the ARIES team tries to do is try to help everybody take a little step back and take some of that emotion out of the equation. These are just way too many words on the screen, Craig, for me to do. So just understand, we're a nonprofit. This presentation is meant to be educational. We share it on our YouTube channel. We share it on our website, like we said. All we ask is that if you are going to do that, that you share it in an educational manner as well. Myself, Craig, the rest of the ARIES team, however, does say that if you do ever have any questions, whether they be legal, tax, or financial, that you seek out the help of a professional to get those questions answered. Okay, we got through that part. Now we get to the fun part of the evening, which is, hey, we call this Think with a Drink. And the reason for that is we understand that sometimes financial information, some of this stuff gets a little unwieldy, gets a little, daunting for some people, and they're challenged by it. And so all we try to do with Think with a Drink is make it more relatable, put it in a casual and more relaxed atmosphere. And we can't think of a better way to do that than as if we have something to sip on as we're going along. And for this evening, I have chosen, this is Ship Shape. This is a Czech-style Pilsner from our friends at Treehouse Brewing. If you don't know the story behind Treehouse, they're out in Charlton, but they have a couple of ones in Deerfield and another one they just opened on the Cape. That if you ever get a chance to stop by, you have to stop by because the beer is phenomenal and the amount of taps that they have is great in terms of the beer that's available. But Ship Shape is a Czech Pilsner. Done with Bohemian, in the style, which is, Bohemian malts and Saaz, that's S-A-A-Z, hops, right? So, certainly a very, very drinkable beer on a hot day. And of course, going into more hot weather, it's going to get humid as we go here through the rest of the week. But one of the things with this, we talked about this before with some ideas on pairings, which I think we want to add in a little bit here as we do this. So if you're ever out and you're ordering like nachos or pulled pork, or even better, pulled pork nachos type of thing, right? That's perfect pairing for a Czech-style Pilsner, right?
Definitely an upscale pairing of beer and pork nachos. I like it.
Yes, well, it's a very good one for it. So if I'm never going to get too high class with you. Let's face that, right? So we pulled pork nachos is as high as we're going.
What's the best wine
this evening, Craig? What are you drinking?
I'm actually going Treehouse as well, and I'm drinking Juice Machine.
Oh, so that's out of the out of the Julius line there in
It
terms
absolutely
of
is, yeah, with unforgiving flavors of mango and orange. And it's really cool is they have the robot on the label from Lost in Space, right?
okay. I can't see it that well, but are we sure that's not the Jetsons?
It's not the Jetsons. That's Rosie. That's the maid. This is that one of those first robots from the 60s with the globe head and the two black arms.
Oh yeah, yeah. Dr. Smith, warning, warning.
Yes, that one. Yep.
Oh, interesting. Very nice. Well, here's the skull.
Oh, oh, very citrusy. You would not like it. I like
I'm
it.
trying to pick up with you do get a little bit of that, let's call it doughy flavor with the see. That's why it would sort of pair with that. That's why you want that spice, that cheese to go there. That's where the nachos come into play with that.
I thought you said
Next
last
one is this crazy animal that's called, variable universal life. So variable universal life takes the concept of the universal life, the index, except for in doing it based on an index where you're just getting credited with either a cap or participation and you can't lose money. This is being invested directly into the market.
Yep.
We're buying mutual funds inside the policy, and the market is doing whatever the market does. Excuse me for 1 second. That if the market goes down, the valuations of the cash value inside the policy go down. And comes to a point that, one of the dangers with variable universal life is that you can run into a margin call on your life insurance policy. Because there may not be enough money in there to offset what you're doing. So like Craig said, suddenly they're going to turn around and say to you, hey, I know you've been paying, $5,000 a year, but now if you want this thing to survive, you got to put another $8,000 or $10,000 into the policy, because otherwise it's not going to survive.
Yeah, because the problem is a lot of times they'll do what's called a target premium, right? And that's enough premium to kind of get the policy going at a minimum. And
right.
Variable, they assume that you're going to get this rate of return that's going to cover the back end, the cost. The issue is if you don't get that return, like Tom said, and get margin called or pulled back because you still got to pay the expenses, you still got to pay the cost of insurance, then all of a sudden there's not enough there. And the target you were paying in to begin with 15 years from now isn't enough to cover the expense. Right. So once again, it can end up being something that implodes on you. These are very, very popular about 15, 20 years ago. But like a lot of things, they over positive what the rate of returns were going to be, over expected the rates of returns, and there'll end up being some issues with them. Now, the other thing is that sometimes there are other what we call riders or little add-ons that you can put in to guarantee certain things, but all those add to the cost and the expense, which can be a drag on the overall return. So
right.
It's a good fit for certain situations, but you just got to make sure you know what you're getting yourself into.
Yeah, well, the number one spot where this comes in is in executive bonus. Most executive bonus plans are done through a variable life chassis for the idea that they're overfunding. Again, that conversation of overfunding in those early or for a time period, 10 years, 12 years, whatever it is, and they're plowing a ton of money in, which offsets the risk of downturns or market turbulation or whatever the case may be.
Dependent on the growth, right? Mm-hmm.
Right. And then eventually the growth is going to kick off and go from there. But it's that you're overfunding in those early years. Yeah, because the same thing, same conversation like IUL with this, it's called BUL, that variable is that if you're not overfunding, it's really not worth it to you to be looking at. So that's the conversation. If you're somebody who's like, okay, I'm going to be plowing extra money in, they told me it was going to be, like I said, 4,000 or 5,000 a year. I'm going to put 8 or 10 in this year.
Right.
And you may be getting a bonus from work or something. Okay, then it fits.
Yeah, where it doesn't fit is to go, well, the premium is going to be less because the income from is going to help make up the difference.
Correct.
I'm doing this on the edge, trying to get as much insurance as I can. And then you play it off and then you're in a position.
Yeah, you blow up. It will never work. You'll never survive on it. So just know that's not a fit for this. You're better off looking at either, the IUL or UL in that situation, or the next one we're going to bring into the conversation, which is the permanent of all permanent, which is whole life, right? And whole life, really is that whole concept, which is it's permanent and it's meant to be paid every month, every year, however it's set up, so that it doesn't ever blow up. There's never any, problems or worries or whatever the case may be. Same idea. You're paying a premium to the insurance company who's deducting the cost of insurance, but unlike a UL or any of the variations off the UL, which are reassessing the cost of insurance based on age every year, the whole life treats you the age that you were when you took the policy out.
Right. You're always that age forever.
You're always that age forever. So if you took this out at 35 years old and now you're 55, you're still paying the cost of insurance like you were a 35-year-old young chipper dude. Right? It's not like you're the 50-year-old, 5-year-old guy you actually are. So that's part of the benefit to the whole life chassis, to the whole life platform, that they allow you, that cost of insurance thing doesn't really play in like it does in a universal chassis. The other is that if you happen to take a loan, because it's building up cash value, just like a UL, just like an IUL, just like a VUL, they all build up cash, and you have access to that cash. Like we said, you can use that cash to offset future premiums. You can use that cash to, buy a car, pay for college, do whatever you want with it. It's your money, right? You can do whatever you want with the cash that's inside the policy. You're taking it out as a loan, as sort of ramifications that go along with that. In the case of the universal chassis policies, that money disappears from the cash value. So the dividends, the returns, all of that crediting, it's not there. In a whole life, they treat it like it's still in the policy.
Yep.
So if you had 50,000 and you lent yourself 20 or 25, they'd still be crediting you like you had 50 inside the policy.
Yeah, I mean, for me, Tom, I really like whole life insurance for solving that problem of making sure it's going to be there when you need it.
Right.
It's the Cadillac, in my opinion, of insurance. Now the Cadillacs are good cars again, right?
Getting there.
I would say that in the 80s or 90s, but now they're back, and I would say it's a Cadillac of insurance. For all the reasons you just said. One, you're not taking the risk. The insurance company's taking on all the risk.
Yep.
You know exactly 20 years from now what your cash value is going to be, guaranteed, if you just make your premium payments.
Right.
You get dividends, it gets even better. But unfortunately,
right. So there's the conversation in that. So just to bring the audience in terms of it. So what happens is, much like universal life, instead of an interest rate, what whole life does is it credits a dividend, much like a bond, much like a CD or something. It's crediting a dividend instead of an interest rate. That dividend is getting paid out. Now, they're not guaranteed. You can't say, hey, that dividend is guaranteed, even though you've paid it every year you've been in existence, because they can't do that. But as Craig said, there's one thing to look at with any policy, and I didn't go through this, and thank you for bringing that up, that every policy will give you a ledger that has two different sides to it. Side number one is the guarantee. That's the charges, the crediting, all of that stuff. How long is the policy going to stay in force, and what's the cash buildup going to be like off the guarantees, which means the maximum they can charge for insurance and the maximum fees they can charge. And then the other side is the non-guaranteed, which is what the current market rates are and what they're currently charging, basically.
Right. And it's competitive with other life insurance companies as well, right? Because otherwise they couldn't sell their policies if they weren't paying competitive dividends. Right? And to your point, yeah, I mean, if a company's been around for 125 years, they probably paid a dividend every year. But because dividends aren't guaranteed, they can't say they're guaranteed. And that's also because the state commissioners tell them they can't say they're guaranteed.
Right. Yeah. No. And that's part of the whole conversation there, is that, you have that aspect to it that you can't do that, as far as it, but you really need to look at, that's the thing that we suggest. Anytime you're looking at permanent policies, you want to look at the ledger and you want to look at the guaranteed side. Show me what the numbers are on the guaranteed size, because that will tell you the worst case scenario as what's going to happen. And if you're okay on the worst case scenario, then like Craig said, the other side just gets better.
Yeah, and I think the big thing too that scares people when they think about life insurance, they go, "Why would I buy this? It only helps me if I'm dead," and I'm dead, so it only helps the other
Well,
people.
we're going to get to that with the questions. We'll get to that in a second with the questions, with that whole part of it. But, same idea. So, again, it says you got fixed premiums, you get paid to the insurance company. It builds up cash value, which again can be used. And then there's a death benefit that gets paid out to your beneficiaries upon your death because it's permanent and it's always there. All right. So we move on to a little bit different version now, which is, group coverage. So, group coverage, these are, 99.5% of the time, that annual renewable term that Craig was talking about. That's what a group policy is. And all they do is take the census for the company and say, here's what the pool is. This is what we're going to charge you to cover all of these people for 1 year of term coverage. And it's usually either a base number, right, Craig, like $50,000 or, 1 or 2 times your salary.
Correct. That's correct. And usually the company's doing a little bit of an offset, which makes it a little less expensive.
Right. So the 50,000 is just simple for them to calculate, but that's usually how a group coverage comes into play. Right. So you're covered. Usually the employer is providing this for you. It's paid for by the employer. They're giving it to you as a benefit. And you've got $50,000 worth of coverage or one-time salary, whatever that may be. And that's what you're getting. Mm-hmm. What goes from there, what moves with that then is a lot of times you get offered supplemental and or AD&D. And we're going to start with AD&D first because that's the fun one to talk about, right? That's more of the fun one. That is accidental death and dismemberment.
What?
And when we talk about dismemberment, we're just not talking about losing one thing. It's you got to lose a couple basically. It's like multiple digits that have to go or things in terms of it. Yeah. It has to be accidental. And here's the thing with that. The number of deaths that actually result from an accident is very, very small. It's the percentage is like under like 15% or something, right? I mean, it's a very small number.
Yeah, and that's why this is so inexpensive and they give you so much of it for so little because they know it's almost statistically almost never paying out on this thing. Right. I mean, to lose it. I mean, unless you're working with, in an industry, maybe in manufacturing where you may have an industrial accident, where you might have both of them.
Yeah, then the whole hand goes in and the machine chops it off. Yeah, okay, that I understand.
Right.
But yeah, no, for the most part though, so AD&D, it's just usually an add-on. So sometimes they'll give it to you, sometimes they won't. Sometimes they'll say, hey, you can buy extra AD&D coverage to go along with the life insurance, the group term that we gave you. We don't recommend that. But if they offer you supplemental, that's something to be looking at because a lot of times they'll let you buy additional coverage, again, based off your salary usually to have as coverage. And again, it's based off a 1 year term policy, the whole census of the company. So usually it's fairly cheap in terms of the dollars. I mean, unless you work at a company with a whole lot of old people who smoke, you probably got a fairly reasonable rate for that.
Yeah, and the other issue too, like you said, Tom, is because accidents don't happen a lot. Let's say they give you a $50,000 as a group coverage, and then they're giving you $50,000 supplemental in accident. I would just consider that you only have 50,000 in coverage because it's so rare that someone actually would die in an accident. I say, if someone does die and has a stroke or heart attack, bring them up on the roof and throw them off,
Right. No. But the supplemental is regular coverage. They're giving you, that's what you're purchasing. The employer paid for the original 50. Now you're buying 50 or 100 yourself.
Oh, I'm just talking about the AD&D. I'm sorry.
Right. Yeah. No. The AD&D is like I said, if they're offering you AD&D, we generally don't recommend it because it's just one of those things that's like, okay, it's rare, so rare to have it happen, which is why they can do it so cheaply.
Right. And I'm not saying don't take it because it does, if it costs pennies, then that's fine. But
Right, depending on the cost and what that does and where it's at and that part of it. Right, good point. All right, so questions that come up a lot, right? So the first one, do I need life insurance? Right? So, let's start there. This is like, do I need a will? Because it's a similar type of conversation. Like, if you have somebody who relies on you in any way, shape, or form for expenses, maintaining the household income budget, whatever the case may be, then you should have life insurance. If you have children, you should have life insurance.
Mm-hmm.
If you have a beneficiary, a wife, kids, you should have life insurance.
Mm-hmm. Yeah, the other reason you may want to have life insurance is because you may have an estate you want to leave, right? So you may have, charities you want to leave money to. The other thing is
charitable deduction. Do a nice job. Yes, charities.
Yeah, and it's a great way to leave money to charities. The other thing is, it allows you in estate planning to leave your assets to a charity and leave the money in the life insurance policy to your heirs. Much cleaner way of doing things. And then
right. And it also, like you just said, like in the case of depending on how much, the state of Massachusetts, the $1 million threshold isn't that high in terms of the state estate tax, that you can have that to offset the tax that's due at the time you die.
Right, but the issue is if you leave all of your assets to a charity and then you leave the life insurance owned by a trust and that goes to your benefactors, then there is no estate tax.
Right.
Right. But the bigger part is because a lot of policies, and you got to look into this, have certain riders that add to your living benefit. One of them, in almost everyone, especially in the state of Massachusetts, I don't know about every single state, is critical care, where it allows you to access a part of the death benefit for if you have an issue where you have two activities daily living that you can't do, right, over a certain period of time. So you could access up to 50 or 60% of the death benefit. So if it was 100,000, that allows you access to $50,000 or $60,000 of cash money that you can use to help with your care.
Right. That's the end of life, that type of thing.
When a terminal illness rider as well. And even some of them have what we call disability riders, where if you're actually paying the premium, you can convert it and the insurance company will keep paying the premium for you if you're disabled. Right. It allows it to continue to build up cash value that you're not. So it's a
Well, that's if it's a permanent policy, and the term policy, they're just paying the term.
Well, it depends. Some of the term policies are automatically convertible.
Right, but some aren't. Right. So it just depends on what you're dealing with in terms of that.
You're saying there could be a lot of reasons why you could even need life insurance if you're single.
Correct. All right. I have coverage through my work. Isn't that enough? Well, here's the thing. We didn't talk about it with group because I knew the question was coming up. The problem with group coverage is that, again, 98, 97% of the policies, once you leave your employer, that policy ends. So you don't have coverage anymore once you leave that employment. There's convertibility. That's what's known as being able to take the policy with you. But it's very, very infrequent that the coverage for convertibility exists. Mm-hmm. So if you leave your employer, you don't have coverage anymore. And depending on the situation, like I just had a conversation with a couple today, like the individual's getting coverage through her employer, but it's 1 times her salary.
Right.
She's making okay money, but it's not great money. And it's definitely not enough to cover the need, like Craig said, because she has another 30 years to work. Like there's no way it's enough coverage. So I'm like, look, I'm going to tell you, this is something you need to be thinking about to do this, because that's not enough coverage for you.
Right. Okay, family, you're good for 1 year, but after that, you're on your own.
Right. Then you're on your own in terms of dealing with it. Does it require a medical exam? In most cases, depending on the amount of coverage, we'll talk about our offer in a second, but for most companies, if you go more than either 250 or 500,000, they're going to require, and as you get older, they are absolutely going to require a medical exam, having a nurse practitioner, drawing blood, all of that stuff comes into the equation.
Right. Yeah. The issue too is like you'll see lots and lots of commercials out there saying no medical exam required, no medical exam required. Because what they're doing is they're throwing you into a pool based on smoker rates, right? And you're paying a much higher, because they're assuming you're in the worst health possible, and you're paying a much higher rate because of that. And you also got to read the fine print too. In a lot of those cases, if you die in the first 2 years, all they give you back is your premium, right?
Yeah.
So you got it. And like I said, sometimes the cost of insurance per unit, the unit being $1,000 of coverage, can be astronomical because you're not underwritten.
Cool.
So just want to be careful with that as well.
How much insurance should I have? That's another question that comes up. Like Craig said, a lot of that is based on, how long you're going to be working. Some of it's based on the liability issues, like you talked about, the debt. What are you trying to cover? You're trying to cover paying off the debt, trying to pay off, the kids' education. What are you trying to do? It's, everybody's got different parts, different variables to what they're trying to cover. So it's not an easy, steadfast answer because there are a lot of factors that go along with that.
Right. And some things that some people don't think about is, well, my wife was still working, so we don't need this much if I died, or my husband would still be working if I died. The issue is it's more than the value of what you earn. It's also, what do you do at the home that now you got to hire someone to do? So there's additional costs for that too. The other thing is, there's an emotional impact. Some people can't go right back to work.
Yeah.
Sometimes they're taking care of things they weren't taking. So you just want to take all those types of things into consideration.
Yeah, no, and it's one of those conversations. Like if you have younger kids, it's like, well, okay, well, I'm just going to continue to work. The dads say that a lot. Like if she passes, I'm just going to continue to work. I'm like, yeah, who's taking care of the kids then? Right? Who's getting them ready and doing stuff and taking care of all that stuff? And it's like, oh wait, I didn't think about that. I'm like, yeah, you've got another 7-8 years before they become somewhat independent. To do that, you got to factor those costs in as well.
Absolutely. Yep.
How much will it cost? That's look, as Craig said earlier, the whole idea here is you've got to qualify for coverage. Coverage is all based on your age and your health. So if you are young and healthy, more than likely you're going to fit the best possible rating or a high rating available. If you're old and out of shape and not healthy and you smoke, all of a sudden the costs go dramatically through the roof. Smokers get hit with a 40 to 50% premium increase. So
it's also gender bias too. This is where women get a break, right? Well, coverage is cheaper for women than it is for men because they expect they're going to live longer.
Women live longer, they take better care of themselves. Absolutely. So it is one of those situations that does happen, right? Why do I need it after I retire? Right? I got to the end of the line. I'm retired. The house is paid off. The kids are gone. Why do I need more insurance?
Well, sometimes when we look at insurance, it has multiple uses. But one of the unknown uses is, how do I use that to have a better distribution strategy in retirement assets? And that's a whole nother topic for another thing.
Right, but that's the offset, right? Because that money, like you talked about, becomes like a Roth. That's my cash. I can now take that cash and there's no tax consequence.
Right. It also allows you to create retirement streams because you have something to replace income with should you be gone. It allows you to deal with estates. It allows you to leave money to heirs. It may have built-in benefits like we talked about with, disability or, terminal illness or catastrophic care. So there may be a lot of reasons that it's very beneficial to have a policy after you retire.
And then let's face the one that comes up for everybody, which is final expenses, right? Burial, dealing with that there might be some debt that is also there. So there are a lot of reasons for it. So it's not just like, hey, I got to the end of the line, I'm done. No, there's other stuff that continues to go on. Depends on the age of you and your spouse. If your spouse is younger, like then what happens? So you got a lot of factors that you have to look at with that. All right, so this whole buy term and invest the rest, right? So this is something you may have heard, something you may have actually looked at or listened to at some point. I will tell you, my industry is responsible for this. The investment guys are the ones who tell you buy term and invest the rest. That's the whole idea. So it does a couple of things here. The first one is it presupposes that you as the individual are going to take the policy, the term policy out, and that it was going to cost you, say, $100 for the term, but it was going to cost you $500 for the permanent coverage. That you are then every month going to take the difference and be investing it in whatever mutual fund index, ETF that you're choosing to do on a regular basis. And from Craig and I, we know from experience that most of us do not follow through on that and continue to do it. So there's the one fall down with that. The second is, depending on when your timeline ends, like if it ended in the beginning of 2022, you would have lost 20% of your value at that particular moment in time. And if you died at that point, there would be 20% less in your fund than what you had when you started. And there's no way to guarantee that the money's going to be there.
Let's be honest, Americans are notoriously bad at saving.
Correct.
Right. And we're notoriously bad at saving on a regular basis. So in order to do buy term and invest the rest, what you're basically saying is the money I would have put into the permanent policy, I'm now going to take and invest on regular intervals every month, like I would have paid my premium, and do that. That doesn't happen. But
right.
We
doesn't work.
want to say we're going to be the exception. We're not the exception. No one's the exception, right? We all say we're going to be, but we're not. And so now we get 15 years down the road, plan didn't work out the way we wanted, and we're like kicking ourselves, saying, well, geez, that didn't work out how I wanted. And now my term insurance just ended. Now what do I do?
Right. Now what do I do? I don't have anything. I don't have any cash build up. I got nothing. What am I doing? So there's a lot there that goes awry with it. So you just need to be wary of it and be thinking about that when anybody says it to you or looks at it and say, wait, can I base this? Let me look at some of the numbers here in terms of going through it and figuring that out.
Yeah, the other thing too, a big thing, Tom, I find with this is when you're buying life insurance, you're looking for something that is guaranteed. You're looking for something that's going to be there if you're not.
Yeah.
By taking
That's the end result of it, the whole idea and the whole premise is that it's meant to be there when you pass.
So the issue becomes when you start trying to invest in difference or, shaving it this way or trying to make money to offset the premium, you're taking risk.
Yeah.
What you're trying to avoid with insurance is avoiding risk.
Right.
It's there in case risk happens. You're not trying to create additional. So that's just something to take into consideration when you're looking at the entire picture.
Right. Absolutely. So